Hello, I'm Chris Pedersen and this is Stock Watch on Thursday, the 2nd of May, 2024. All information is general advice and may not be suitable for you. Always consult your advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Few of my market observations. Sell in May and go away? Well, does that apply this month? Obviously, I don't have a crystal ball, so I don't know. But what I do know is that's probably not the right question to ask. I think what people should be saying is, when will the RBA lower rates and when will the U.S. Federal Reserve start to lower rates? By the way, from their recent statements, neither central bank really knows for sure. They have been saying, though, that they're data-driven in their decisions. And all the economists around the world are like going, well, yes, that's good, and then they're trying to make assumptions around that. My comment is real simple. Would we expect them to be anything other than data dependent? It's kind of a basic question. And when they say that, isn't that really Fed speak for they don't know? This list is the ASX 100 companies, the top 12 performers. This is always a very attractive thing to be looking at, because companies making new highs tend to continue doing so. Obviously, they make new highs, there might be a pullback, a consolidation, but there's a reason they're making new highs. They're performing well, so you want to take a look at them as a starting point. This list is the top performers of the small ords. These aren't necessarily companies I cover all the time because, one, liquidity, small market cap, lack of research, lack of reliability in the forward projections. But nonetheless, this is a good list for looking at some small cap stocks that you might want to drill into. Here's a chart that I thought was absolutely fascinating and tells us everything we want to know about what's going on economically, in the media, and with brokers. Is inflation going back up? And this is a chart. Take a look. We see that inflation is coming down. And as it goes down, look at the black line and the other lines, but black is easiest to see. There are times when it picks up a little bit and then declines, goes up again, declines. And right now on the right-hand side, there's a little bit of a tick up. So everybody's worried and concerned, geez, inflation is maybe going to go back up. Well, we don't really know for sure, but the trend is downwards. It is positive. A lot of the problems that created inflation are solved, like supply chain. Wage growth has already been pumped through the economies. So we don't know if inflation is killed yet, but we do know that central banks aren't sure, and they aren't going to be cutting rates anytime soon. Non-farm payroll productivity. This is another chart that I wanted to show you because it tells us a huge amount of information. Economists right now, and the press, and your brokers are saying, geez, maybe the economy is slowing. We're going to have a recession. The recession we've been waiting for 3 years is upon us. Well, non-farm U.S. productivity, this is telling us that it's actually very strong. With strong productivity, that is not a sign that the economy is doing poorly. Yes, this is just one statistic, but it's an important statistic. It's a little fuzzy out there because so many different things that are saying positive, negative, but this one is one of the more important ones. This chart's absolutely fascinating also because it shows us U.S. interest payments versus GDP, which says that the amount of interest the U.S. government is paying has been declining. It's been declining for a long time. Is this the right question to be asking, though? My feeling is it's not that the debt is too high. As a percentage of GDP, that's been actually coming down some. But the question is the amount of debt and the interest on the debt as a percentage of the total government budget. You see, as the economy grows, the U.S. government grows, but if the U.S. government doesn't pass tax increases or continues to pass tax cuts, then the interest to total government budget revenue is getting worse. That's what the problem is. Not the total debt, because debt to GDP is under control. It is interest versus total budget. And then the other line is bond yields. Well, we know that interest rates have been declining. Bonds have declined since 1983, and we had 40 years of amazing bull market in 10-year, 20-year bonds. I mean, Blind Freddie would have made money on a long-term basis because obviously there's hiccups along the way, but long-term bond funds have outperformed equities because of this big decline. But those days are over. Now bonds are not so safe because interest rates have risen. Now bonds have a big impact. When interest rates rise, bond prices go down. When interest rates drop, bond prices go up. Next chart here, I just threw this in. This is from UBS, and it shows countries and their market call form. What is surprising and why I'm showing it is because China, they now rate China as overweight. For the past 5 years, China's been a very poor performer. Now it's looking like it's improving. So you ask yourself, how can it be improving when their real estate market is still in the tank? Well, because real estate's only a part of their economy. They're still building roads. They're still growing technology. It's still a massive country of 1.3 billion people. So they are getting their act together, but they do have to work through this property problem. Company that I wanted to cover today was brought to my attention, so I wanted to drill into it. It's TechnologyOne. It trades on the ASX under the code of TNE. Right now it's trading $16.09. Well, for a long time this company's performed very well. This is a 5-year chart, but what you see is the past 1 year it's been starting to stagnate. But let's take a look at the numbers. It's a market cap of around $5 billion, so it's a significant company. I have a price target of $15.50, which is below where it's currently trading. Some brokers are like $16.10 and they have a neutral rating. Other brokers are $16.50. I happen to be a little bit on the low side, and this is why. The revenue growth rate from 2023 to 2026, I show is 15% per annum. This is very attractive. The earnings per share growth for this period is also very attractive at 16%. The dividend growth rate is 16% per year. So these are all very strong numbers. But now we look at why I feel it's overpriced. The PE on the 2025 earnings estimate of 43 cents is a huge 37 times. And the yield for the 2025 with a dividend of 27.5 cents is only 1.7%. Well, I'm not too concerned about the dividend yield on a technology company because it's growing. Growth stocks don't need to pay a dividend. It's only as they mature that they need to become more of an income stock. This PE at 37 times makes this company not attractive at this price. It has free cash flow of around 2.5% and a payout ratio of 62%. I wish they didn't have that high payout ratio. So TechnologyOne, what do? They provide integrated software solutions for governments and private sector like healthcare, financial services, etc. Don't get me wrong, this is a good company. It has good growth. Problem is it's fully priced. If the stock comes down, I would rate it a buy, but right now I rate it neutral. The second company today is Smart Parking Limited. Code on the ASX is SPZ. It's trading at 47 cents. I don't normally cover really small cap stocks like this. This came across my desk. I decided to take a look at it. And the reason is that when it comes to parking, I know from New York to Houston to Chicago to San Francisco and LA and Australia, you look at Melbourne and Sydney, Brisbane, the companies that are in the car parking business tend to do well. It's a boring segment. People don't really look at it, but everybody has cars. They need a place to park, and this company is in that sector. It's not that they own the car park, but they own a lot of the technology behind the car parks. Looking at the numbers here, it's trading at 47 cents. It's got a market cap of only 170 million. I have a 12-month price target of 65 cents. And this is because the revenue growth for each of the next 3 years I show is 21% per annum. This is extraordinary. The earnings per share growth, 34%. Now bear in mind, the earnings per share growth is off of a low base, which makes it easier to have a high growth. But nonetheless, on the dividend side, they don't pay a dividend. That's okay. The PE on the 2025 earnings estimate, which I have is 37.5 cents, is only 12.5 times. Now this is extraordinary. Company with these growth levels at a PE this low, this is way undervalued. Now because it doesn't have a dividend, it has no yield. Now I didn't look at the free cash flow, but I did look at 2025 earnings valuation divided by EBITDA, and that's 6.5 times. This makes it attractive also on a value basis. Smart Parking, as I mentioned, is engaged in the design, development, and management of parking technology. Side issue here is Chris Morris of ComputerShare, he's the founder of it, is the chairman. This company fundamentally is cheap. I rate it a buy. I don't know about liquidity. It's a small market cap, so you're not going to be able to pump massive amounts of money into it. But it does look like it has legs for the long haul. As always, if you want to learn more about anything I covered today, send an email request to stockwatch@fnn.com.au and address it to me, Chris Pedersen, and I will endeavor to get back to you. Have a wonderful week, and I hope it's profitable. Thank you for your time.